Everyone, it's Nick with Us versus Herd. We're going to be live streaming today's Fed announcement, Fed rate announcement here in just a few minutes. Also going to be live streaming, Mr. Powell. See what we got to do here. See what we can do. See the market. The market today has kind of been chopping sideways. Nasdaq's pretty much back to where it opened up at. S&P, the S&P didn't go anywhere either. Dow, I think Dow's down actually. Yeah, Dow's actually down from where it opened at this morning, just a little bit. Russell was moving hot. The Russell was moving hot, but now the Russell is flagging here. So audio's bad. Hold on. Audio is bad. How about now? Let me know. Test. Oh, it's on the wrong mic. Hold on. Test. Okay. I think we're good. How about this? All right, sorry about that. I don't know. I put these headphones in. It's got a mic on here too. I put these headphones in because I want to be able to hear Powell as well when we do the segment for Powell here. So let me get situated here. If you're here right now, drop a like. Say what up in the chat. All right, so we're chilling right now. Apple's hanging on to 150. Zillow's a big mover today. They got caught up in the housing market here. Let me pull up. CNBC's gonna drop the rates here. Let me pull this up while we're waiting here. So Zillow got caught up in the house flipping market. They actually, I mean, good for. I mean, I don't like to see people lose, but I do like to see people, kind of messy back there. Sorry, guys. Jeffrey Byers, Jeff Lilly, Dari, Ramsey, Emmanuel. What's going on? But yeah, Zillow got caught up in the housing market, trying to flip homes. Their AI worked against them. They were buying homes for way too much money than what they were. Got smoked and lost almost $500 million. And they're selling 7,000 homes to BlackRock. So those homes are not going to be hitting the market, which is bad for everybody, and also for the home values, because obviously if you're looking for a home, like I am right now looking for a home, it's been a struggle. I mean, you've literally seen home prices go up. You're looking at the price one day, next day they're $100,000 more. $50,000. It's like, oh yeah, you need to put an all cash in offer. We have 48 bids on this home. Good luck to you. And you know how many you win? Zero. And they're like, well, if you could write a letter to the owner, maybe they'll pick you. Like, what is this? What is this? Not a popularity contest, So Zillow got caught up in that. We got I'm watching Bad Bath & Beyond. It's up 19%, but there was a huge short squeeze after hours yesterday. Hit 32, now down to 19. I mean, that's crazy. That's crazy. Taking the SPY for a quick swing. Yo, good luck, man. Good luck. I mean, the rates are about to come out here in just like 30 seconds, so I'm just waiting on here. Biding my time. So we got SPY. I mean, SPY literally, like, if you look at this, just chopping all day long, just waiting. Only one that's been performing well is the Russell. Russell's been doing well. I didn't have lunch today. Got a little cherry Coke. I'm not begging for a house. Yeah, I mean, it's ridiculous. Like, I'm not going to sit there and try to beg for a home. So, I mean, I sold my house, and now I'm in the process of finding another one, but it hasn't been fun. All right. So it's 2 p.m. Eastern time right now. Rates have just come out, so we're seeing when these are going to hit CNBC here. Let's see what we can do. CNBC is not posted anything yet. Getting a small movement here out the gate. Apple's not moving yet either. Yo, Matt, what's happening, man? Okay, here we go. All right. Okay. So, Fed to start tapering bond purchases later this month. Starts pulling back on pandemic aid. SPY's ripping right now. 462. It will reduce the pace of monthly bond purchases, the first step towards pulling back on the massive amount of help it had been providing markets and the economy. Tapering of bond purchases will start later this month, so sometime in November here. Policymaking Federal Open Market Committee said in the post-meeting statement, the process will see a reduction of $15 billion each month, $10 billion in treasuries, and $5 billion in mortgage-backed securities from the current $120 billion a month the Fed is buying. So basically they're going to be cutting back a little bit more than 10%. So I mean, not 120 billion a month. The move came in light of the substantial further progress the economy has made toward the committee's goals since last December. So interesting. Let's see here. Let's go back. Let's see, what do they have here for? Inflation is elevated, largely reflecting factors that are expected to be transitory. Supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. Yeah, beef is like up 10%. You guys go to the grocery store, you're paying like, it's a lot. It's been a while since I went to the grocery store. I went to the grocery store, I'm like, whoo. It's real. It's real. The tie between interest rates and tapering is a vital one, and the statement stressed that investors should not view the reduction in purchases as a signal that rate hikes are imminent. So they're reducing like a little bit. I mean, I would say this is not like America has a spending problem. Yo, bro, you think? I mean, we absolutely have a spending problem. So right now, SPY's back down to flat for the most part. Saw a little bump here. Came back down. On the current schedule, the reduction in bond purchases will start later in November and conclude around July 2022. Officials have said they don't envision rate hikes beginning until tapering is finished. So I guess the good news is, unless something crazy or something bad happens or inflation's like crazy high, looks like probably why the market's reacting here is we're not going to be getting any rate increases till around, which it says here, July 2022. But we know things can change. Probably that's why the market's reacting the way it's reacting, because they're not going to release like, hey, we're going to taper and raise rates at the same time. So that's why the market's probably reacting pretty good to this, even though the purchasing will be down about 10 to 12%. They're going to start tapering. I wonder what happens. So they're going to after the tapering. I mean, they're only going to be tapering $15 billion, so that means they're still going to be spending $100 billion a month. I mean, that's a lot of money. That's a lot of money. That's $1 trillion a year. Over $1 trillion. So nothing. Markets, though, have been more aggressive in pricing. So I guess it depends on, right now, Powell's going to be coming on in 25 minutes, so it's gonna be interesting here. What do you guys think? You guys think this is good? This is bad? So they pretty much agreed to, we're going to taper about 10 to 15%. we're not going to raise rates till July 2022 or when tapering's done, but we know things change with inflation and stuff like that. So they're kind of, what do you guys think? They're just going to like trial out tapering and kind of see where we're going, or right now Apple's moving. Nasdaq ripped. Nasdaq ripped right out here. It can solve world hunger. Yeah, it's kind of crazy. Tesla got a little rupee. I mean, it depends. I don't know. Market's not. I mean, the market's up a little bit, but it's not like anything crazy. I mean, it's not like a huge reaction or anything. You know, like nothing really is happening right now. I mean, are we waiting for Powell to say what's going to happen? I mean, so essentially they're going to taper starting later this month. They're not raising rates till July 2022, which, you know, that's good. But I think if inflation gets out of control, I mean, if inflation gets out of control, they're going to have to raise rates, right? Yo, Ben, what's happening, man? Yo, Kit. If you could just do me a favor, hit the like button. Definitely appreciate it. SPY hit 462. Hey, new all-time high. So all day we've been consolidating on SPY, and now we just made a push up. Let's take a look at the Qs here. Qs consolidating, push up 391. That's a new high too. Let's see Dow. How's Dow doing? Dow was selling pretty hard pre-Fed, and now it's popped up, but it's not like doing great. Want to mention Dell at all? Yeah, why did they push Dell out? I mean, VMware out. Were they afraid of getting too big, or what? Or was it were they forced to from the SEC? Yeah, I mean, bullish for not raising rates. Tapering is, I don't think they're tapering like enough. You know, like I don't think they're tapering enough. Like they should cut back purchases like 50%. Yeah, Dell got massacred. So the market, I mean, I would say the market's not really reacting to this at all. Like it's big nothing. The market is just chilling. We'll see if it can keep this up here. I mean, I'm gonna live stream Powell here in about it's 22 minutes or so. So I'm gonna hang out, take some stocks. Yeah, Dell. Dell's down bad. But I don't know like what you would do with Dell here. You know what I mean? Like what do you want to do with it? What would you do? VMware is a big business though. I don't know why they split. I have to look into it a little bit more. Apple is chilling right now. Apple's coming back down. Yeah, I traded some futures this morning. I lost about 250 today. I was down 900 at one point. I was just getting chopped up. So when I got back, most of that just said, you know, it's time to be done. Today is not the day. Can I say the N-word in here? What? No. You're gonna get banned. You're gonna get banned. What? What? I don't even like what. You know, this is why you take a break from YouTube and freaking, you know. Anyways, Bunch of weirdos. I mean, I mean, what? Like, what? Anyways, VIX fell. VIX fell pretty hard here, but it's bouncing back. Yeah, I took a break to YouTube and you know, I'm trying to I'm trying to get back up on here, and this is what I come back to. I don't even know. I don't even know. Like I don't know. Yo, what's going on, Panic? What MAs do you use, Alex? So I pull it up for you here while we wait for Mr. Powell. So on the 1 year, I don't know if you could zoom in here. I don't think I can make this bigger. It's just the screen. So I use the 10, 50, the 200. These are primarily what I'm looking at on the 1 year, 10 day, 50 day, and then the 200 day. I also have in here the 100 day as well. Let me push that up here. It's 2021. You think this stuff would be drag and drop, you know? So I have the 10, 50, 100, 200 day. And then for like right in here, like for these, I just trade off of the 9 moving average exponential. Yo, welcome back. I don't know what's going on, guys. I'm just trying to have a good time, relax, see what the Fed's doing, you know, and you guys got to come up in here. You know, this is why the metaverse is going to be an awful place. Like, people on the metaverse are just going to be, you know, wilding out right here. The metaverse is going to be toxic. You know, Facebook is like, oh, anyway, I don't even want to get into that. Tesla popped on down. It had a nice pump right here at 11.55, but it's been fading. I mean, it looks like, low key Bradley. It looks like Dell has stopped bleeding. I mean, it's not, but you obviously want to give it like the 3-day rule. You know, this is the hardest I ever laughed. Can't wait to stream again, guys. Like, this is great. I mean, what the? Well, at least we get some laughs out of it, right? I mean, AMD is nonstop. Hit 130. All right, what stocks? While we're waiting for Powell in like 15 minutes, what stocks do you guys want to look at? Look how snow is treating people today. I mean, this has been going on a steady grind up here from 340 up to 363 yesterday. Today, they literally, like, look at today. They gap down and then flushes all the way down to 346 and just been bleeding. That's crazy. Did Amazon relaxers one in every car? Amazon. Yeah, Amazon popped up there, but I mean, Amazon 3,300 right here. I mean, it's mid range. It's mid range right now. Your face when you look at the camera and roll your eyes when drinking the Dr. Fumes goes at it. I was like, I don't know what's going on today, Kit. Like, I don't freaking. You know, there's that line in the College Dropout by Kanye. He goes, you know, racism's still alive. They just be concealing it. But nowadays they don't even conceal it. You know what I mean? SIXD? What is SIXD? It's not even loading anything. I'm going to sneeze. Okay, I'm not going to sneeze. Anybody here trading Sentinel 1? So they're the ticker S. They took over the ticker S that used to be formerly was Sprint, now is Sentinel 1, which is a cybersecurity, antivirus, anti-ransomware company. I've been kind of monitoring this situation here. It had a pretty explosive move to the upside here from the 50s, but I mean, what do you think? Do we think it's going to kind of retrace here a little bit? Yo, man, I hope the weed stocks. I hope the weed stocks, you know, make a move. Right now, weed stocks are not it. I mean, SNDL's bad. It's just hitting at 60s. MJ, it's just been bleeding. I mean, it's crazy. We had, you know, after the election was this massive run, right? And now a lot of these stocks that were trading at, you know, they said like everything back in, what was it, January, February was just explosive, and now those are down like 50 to 80%. Some of them were even down like 90%. This guy's getting freaking. How do I freaking. I don't even know how to ban people. I don't even know how to ban people. Where's this guy? Sorry, guys. Hold on. It's freaking. I don't know. I don't know how to ban people. I'm trying to. I'm gonna have to figure that out. What the? I don't know. I don't know how to ban. I don't know how to ban people. You better not be in our Discord. We're gonna find you. Anyways, we got a couple minutes till Powell comes on. Let me actually get this. Let's try to find the Fed here. Let's see, do we have a link to the Fed yet? CHGG. Yeah, let's look at yeah, this stock is doing horrible. All right, I'm just getting the all right, I'm just getting the Fed kicked off. Let me put this over. Let me move this over. Let me move this over here, and then we will get the Fed moving. All right. All right. Yeah, Check, bro. I mean, it's looking pretty good here. I mean, if this could break, I mean, if you're looking at the 15-minute chart, I mean, nice bull flag here, but there's no momentum. I mean, a lot of people are hurt right now. A lot of people are hurt right now, but I mean, this thing's been trending down. This was down big even before earnings. I mean, this for the last 2 months has been trending way down. Now, I mean, to get bullish on it, like, I don't just buy dips here. Like, if you're going to buy the dip, I mean, you're going to need to come back up here. I mean, you could try have like a small stop down here, but this is going to be tough. This is going to be a tough road. I don't know. I mean, how was earnings that bad? Two-month hold. Might be more than that. You might want to get leaps. It's crazy. Oh, let's see what SPY's doing. So I think are we waiting for Powell to come on? Is that what everybody's waiting for here? I mean, SPY is just barely green. I mean, we're going nowhere right now. Let's see, Russell is strong. Russell's ripping. Qs are going nowhere. I mean, the charts are looking pretty bullish. Tesla's stuck. Amazon's ripping again. Google's stuck. Yeah, I think we're just waiting for Powell. But I mean, what is he gonna? You think Powell's gonna screw us on this? Think the Powell speech is gonna screw us? You think Lucid can compete against Tesla? I don't think anybody can compete against Tesla. At least in the immediate future. I mean, Tesla's so far ahead. They have their own charging station network. I mean, they're far ahead. Do you think they should raise rates? I think it's time. I think they should raise rates, but they just said that they're not going to be raising rates until tapering's done with, which they're saying tapering will be done in July 2022. So we got another year and a half before interest rates are going to be. But as we know, things change. I mean, if inflation goes up like crazy, then. But right now, the Fed is thinking right now that inflation is just going to be, it's going to spike for the short term and then go back down. But I don't know. They need to chill. I mean, Lucid, if you want to take a shot here, I mean, like what I would do is I would just buy shares. If it comes back down to 25, buy some more shares. I mean, it's consolidated for most of the year. So if you want to buy shares, I don't know if it's going to go back up to the 60 or 50 or whatever. But like for Lucid, they got a long way to go. And I mean, Elon's even said that they've, making cars not easy. Like, why do you think so many car manufacturers go belly up? And even Tesla, like when it was going through its hard times, even though they're successful now, they were trying to get bought by Apple because things were bad. I mean, don't you guys remember like they were having fires in the factory? I mean, it was a mess. People were stealing IP and going to competitors or going to China. I mean, it was crazy. So I know that we have Lucid. We also have the Rivian IPO, which is backed by Amazon, coming out. I mean, maybe go small positions, and whoever doesn't make it doesn't make it. I mean, they're not all gonna. I don't think they're all gonna make it. But I mean, obviously Tesla's the leader. Maybe Rivian. Rivian's backed by Amazon. Amazon will be buying trucks and vans and whatever, electric fleets from Rivian, of course. Lucid, I don't know. There's not. I mean, right now we're going to be in a situation where EV plays are going to be running just because they're EV. How's our buddy Workhorse doing these days? I'm actually surprised it's this high. I definitely thought it would be sub 5. I mean, it hit 6. But Workhorse got freaking. Again, right after the election, major pump, and this thing went from 42 down to 6, and then it's at 7. Lucid has 500 plus mile range. Yeah, I mean, the thing is, like, we gotta see these, and they have to get through like the consumer test. Like, do the consumers like them? Are the consumers recommending them to their friends? Like they have to get to market. Right now, they're not on market. Like, where we don't have any of these cars available, so we don't know. Like, because we know, like, once Tesla started driving and stuff like that, and with their automation, there was crashes, and then there was uproars about safety features and all this kind of stuff. So it's gonna be interesting to see like how these companies fare through all that. Now the good news is for like the Lucids and the Rivians and all these other people. How's that NKLA doing, by the way? Tesla has absolutely paved the way for all these companies, where all these companies are gonna have an easier time because Tesla paved the way, right? So that's why these companies may have some upside. I mean, I don't know. Do these guys even have a car yet? Like, are they going to have a car? Like, that's messed up. I remember you wanted to buy a boatload of Workhorse. No. I mean, it looks, I mean, sometimes the charts look great. And then, I mean, Workhorse, Nikola is freaking, it got, I mean, this thing, I don't know. Is this stock a scam or not a scam? Still trading. It's popped up with the EV plays, but I mean, nowhere near where it was. And I mean, didn't the founder go to jail or something? They were like, I don't know, or he got in trouble. I don't know. Robinhood ripped today. I don't know. Anybody trade Robinhood? Robinhood ripped, and it's holding. They do say GM Ford may do very well in EV. Yeah, I mean GM Ford is I mean, they have the infrastructure. I mean, they have everybody's familiar with the brand, manufacturing. They have all the plants and stuff like that. I think it's going to be. I think Ford and GM are definitely going to be major contenders along with Mercedes, BMW for foreign vehicles, Nissan, Toyota. Which Toyota and Nissan have been making EVs for years, But these fancy new companies, I don't know. The fancy new companies, Lucid, Rivian, Nikola, I don't know. Daniel sold the Hood 40 put. Yeah, I mean, I would anticipate it to come back up to 40. I mean, it's dropped down pretty bad. I mean, it had a nice bump today. But, I mean, this thing has been a nightmare. And with more regulation, especially, I think that they're going to have a harder time to make money. And if people aren't buying crypto and stuff, they're not going to be making money. There's a reason why companies charge money to make trades, right? I mean, they make their money other ways, but I mean, essentially, you have to charge people to make trades. I mean, I don't feel bad for Robinhood. Yeah, Fed. I'm waiting for it here. I have it right here. We're waiting for Powell to come on, but basically, what the Fed said was they're not raising rates until July 2022. They're currently tapering about, they're buying $120 billion worth every month. They're going to taper back to $105 billion a month. So, They they need to. I think they need to taper more. They need to taper more. Prague. I mean, this looks actually pretty good. I mean, it's resting right here on the 200-day moving average, crossed above it. I mean, looks pretty good. You know, like a stock like this, you don't buy the rips, you buy the dips. Otherwise, you're gonna lose. You buy the dips. Oh, looks like our boys here. Hold on.
Toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery. Given the unprecedented nature of the disruptions related to the pandemic and the reopening of the economy, we remain attentive to risks and will ensure that our policy is well positioned to address the full range of plausible economic outcomes. I will say more about our monetary policy decisions after reviewing recent economic developments. Economic activity expanded at a 6.5% pace in the first half of the year, reflecting progress on vaccinations, the reopening of the economy, and strong policy support. In the third quarter, real GDP growth slowed notably from this rapid pace. The summer's surge in COVID cases from the Delta variant has held back the recovery in the sectors most adversely affected by the pandemic, including travel and leisure. Activity has also been restrained by supply constraints and bottlenecks, notably in the motor vehicle industry. As a result, both household spending and business investment flattened out last quarter. Nonetheless, aggregate demand has been very strong this year, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. With COVID case counts receding further and progress on vaccinations, economic growth should pick up this quarter, resulting in strong growth for the year as a whole. Conditions in the labor market have continued to improve, and demand for workers remains very strong. As with overall economic activity, the pace of improvement slowed with the rise in COVID cases. In August and September, job gains averaged 280,000 per month, down from an average of about 1 million jobs per month in June and July. The slowdown has been concentrated in sectors most sensitive to the pandemic, including leisure and hospitality and education. The unemployment rate was 4.8% in September. This figure understates the shortfall in employment, particularly as participation in the labor market remains subdued. Some of the softness in participation likely reflects the aging of the population and retirements. But participation for prime-aged individuals also remains well below pre-pandemic levels, in part reflecting factors related to the pandemic, such as caregiving needs and ongoing concerns about the virus. As a result, employers are having difficulties filling job openings. These impediments to labor supply should diminish with further progress on containing the virus, supporting gains in employment and economic activity. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. Despite progress, joblessness continues to fall disproportionately on African Americans and Hispanics. The supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. In particular, bottlenecks and supply chain disruptions are limiting how quickly production can respond to the rebound in demand in the near term. As a result, overall inflation is running well above our 2% longer run goal. Supply constraints have been larger and longer lasting than anticipated. Nonetheless, it remains the case that the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, specifically the effects on supply and demand from the shutdown, the uneven reopening, and the ongoing effects of the virus itself. We understand the difficulties that high inflation poses for individuals and families, particularly those with limited means to absorb higher prices for essentials such as food and transportation. Our tools cannot ease supply constraints. Like most forecasters, we continue to believe that our dynamic economy will adjust to the supply and demand imbalances, and that as it does, inflation will decline to levels much closer to our 2% longer run goal. Of course, it is very difficult to predict the persistence of supply constraints or their effects on inflation. Global supply chains are complex. They will return to normal function, but the timing of that is highly uncertain. We are committed to our longer run goal of 2% inflation and to having longer term inflation expectations well anchored at this goal. If we were to see signs that the path of inflation, or longer term inflation expectations, was moving materially and persistently beyond levels consistent with our goal, we would use our tools to preserve price stability. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability early in the pandemic, and since then have helped foster smooth market functioning and accommodative financial conditions to support the economy. Last December, the committee stated its intention to continue asset purchases at a pace of at least $120 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. At today's meeting, the committee judged that the economy has met this test and decided to begin reducing the pace of its asset purchases. Beginning later this month, we will reduce the monthly pace of our net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. We also announced another reduction of this size in the monthly purchase pace starting in mid-December, since that month's purchase schedule will be released by the Federal Reserve Bank of New York prior to our December FOMC meeting. If the economy evolves broadly as expected, we judge that similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by the middle of next year. That said, we are prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to support accommodative financial conditions. Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy.
I think
we continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you. We'll go to Nick at the Wall Street Journal.
Hi, Nick Timmeros of the Wall Street Journal. Chair Powell, the markets anticipate you will raise rates once or twice next year. Are they wrong?
So I would say it this way. We try to focus on what we can control, and that is how to communicate as clearly as possible in this highly uncertain world how we're thinking about the economic outlook and the balance of risks, and how policy will evolve in that case, and also in the cases which are frequent where the economy evolves in unexpected ways. So the focus at this meeting is on tapering asset purchases, not on raising rates. It is time to taper, we think, because the economy has achieved substantial further progress toward our goals, measured from last December. We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, both in terms of employment and in terms of participation. Getting to your question, our baseline expectation is that supply bottlenecks and shortages will persist well into next year, and elevated inflation as well, and that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Of course, the timing of that is highly
They
uncertain.
should ask him about his
But certainly
bond
we should
purchases.
see inflation moving down by the second or third quarter. The time for lifting rates and beginning to remove accommodation will depend on the path of the economy. We think we can be patient. If a response is called for, we will not hesitate. So what I will tell you is we'll be watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately. And that's what I would say.
Anything could change,
Well, based
basically.
on, if I could follow up, based on your current outlook for the labor market, do you think it's possible or likely even that maximum employment could be achieved by the second half of next year?
So if you look at the progress that we've made over the course of the last year, if that pace were to continue, then the answer would be yes. I do think that that is possible. Of course, we measure maximum employment based on a wide range of figures, but it's certainly within the realm of possibility.
Thank you.
Thank you. Next, we'll go to Gina at the New York Times.
Hi, Chair Powell. I was wondering if you could detail a little bit how you're thinking about wages at this moment. Obviously, we're seeing strong wage growth, particularly for people in sort of lower income fields. I wonder if you see that as a positive thing or as a potential start to a wage price spiral, and sort of how you sort of delineate those two things.
So wages have been moving up strongly, very strongly. And in particular, I would point to the Employment Compensation Index reading that we got last Friday. Now, in real terms, they had been running a little bit below inflation, so real wages were not really increasing. I think with the ECI reading, it becomes close to maybe not increasing, but close to back to zero in terms of the real increase. So wages moving up, of course, is how standard of living increases over the years for generation upon generation. It's very important, and it's generally a good thing. The concern is a somewhat unusual case where if wages were to be rising persistently and materially above inflation and productivity gains, that could put upward pressure on or downward pressure on margins and cause companies to their employers really to raise prices as a result, and you can find yourself in what we used to call a wage price spiral.
Everyone's
we don't have
raising
evidence of
rates
that
and
yet.
prices already.
Productivity's been very high. The ECI reading is just one reading. Again, if you look back, so we'll be watching this carefully, but I would say that at this point we don't see troubling increases in wages, and we don't expect those to emerge, but we'll be watching carefully.
Next, we'll go to Steve Leisman from CNBC.
Thank you, Mr. Chairman. I wonder if you could perhaps give us your thinking about the trade-offs between inflation and unemployment. You've talked about the shortfall in unemployment or employment relative to before the pandemic, and yet you have inflation, which is affecting everybody.
Ramsey,
are
you're
we
correct.
at or close to a point where the risk of inflation is greater than the benefit that you'd for recovering these lost jobs, so that now from a risk management standpoint, it makes sense to move more aggressively on rate hikes? And kind of a related question, the statement today says you'll keep policy accommodative until you hit that 2% inflation target. Our surveys show looking for 5% inflation this year, 3.5% next year. It sure seems like you're on track to modestly or moderately exceed that 2% target. Thanks.
Yeah, so I'm not
CNBC
sure I
with a
totally
real
got
question.
your first question, but I would say,
Surprised.
in fact, could you just quickly, succinctly say your first question again?
Sure. The idea that the trade-off between inflation and unemployment, that you would keep policy accommodative to put this 5 million folks or find these 5 million jobs again. At the same time, all Americans will be suffering from higher inflation. Is that trade-off worth it, or is it better or smarter to raise rates right now to combat inflation and perhaps not lean so heavily on the employment side of the mandate?
Yeah, so this isn't the traditional Phillips curve situation where there's a direct trade-off, where that's really what we're talking about. The inflation that we're seeing is really not due to a tight labor market. It's due to bottlenecks, and it's due to shortages, and it's due to very strong demand meeting those. So I think it's not the classical situation where you have that precise trade-off. But in this situation, we do have a provision in our
He's talking like Biden
statement
now.
on longer run goals, as you know, that
he's
says
mumbling.
when those two things are in tension, what we do is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with the mandate. So we used to call that the balanced approach paragraph. We have to think about the amount of the deviation. We have to think about the time it will take. And we have to make policy in a world where the two goals are in tension. It's very difficult. But what it really boils down to is something that's common sense, and that is risk management. We have to be aware of the risks that particularly now.
How is he going to talk about risk
significantly
management?
Higher inflation. We see shortages and bottlenecks persisting into next year. We see higher inflation persisting, and we have to be in position to address that risk should it become really a threat should it create a threat of more persistent longer-term inflation. And that's what we think our policy is doing now. It's putting us in a position to be able to address the range of plausible outcomes.
Thank you. Next, we'll go to Colby Smith at the Financial Times.
Thank you. Chair Powell, what are the economic conditions that would perhaps warrant a faster pace of tapering? And I'm wondering how you would also characterize the risks that the Fed may actually need to accelerate that process eventually. Thank you.
So I guess, as I said in my opening remarks, assuming the economy
He's getting frustrated
performs
now.
broadly as expected, the committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month, and we're prepared to deviate from that path if warranted by changes in the economic outlook. So I'm not going to give you a lot more detail on what that might be. Of course, if we do see something like that happening, if it becomes a question, then we'll communicate very transparently and openly about that. But I'm just going to leave it with the words that are in the statement. Sorry, was there a second part?
Tyler, he loaded the boat.
Yeah, it's just on characterizing the risks that you might actually have to do so later on.
I would just leave you with the words we have here. We are prepared to speed up or slow down the pace of reductions in asset purchases if it's warranted by changes in the economic outlook. And again, if we feel like something like that's happening, then we'll be very transparent about it. We wouldn't want to surprise markets. We'll say, in light of this factor or these factors, we are considering doing this, and then we would either do it or not do it. But I'm not going to start making up examples of what that might be today. Thanks.
Thank you.
Yeah, Carmine, they said they're not going to raise rates, and their tapering is minimal.
Next, we'll go to Rachel Siegel at the Washington Post.
Hi, Chair Powell. Thank you so much for taking our questions. You mentioned at the beginning that the Fed understands the difficulties that high inflation poses for individuals and families, especially those with limited means. What is your message to those families or consumers that are struggling with higher prices right now? And do you feel that your expectations around transitory inflation that message is reaching them? Thank you.
Yeah. So, first of all, it is our job and we accept responsibility and accountability for inflation in the medium term. We're accountable to Congress and to the American people for maximum employment and price stability. The level of inflation we have right now is not at all consistent with price stability. By the way, we're also not at maximum employment, as I mentioned. So I would want to assure people that we will use our tools as appropriate to get inflation under control. We don't think it's a good time to raise interest rates, though, because we want to see the labor market heal further. And we have very good reason to think that will happen as the Delta variant declines, which it's doing now. As I mentioned, so transitory is a word that people have had different understandings of. For some, it carries a sense of short-lived. And that's there's a real time component measured in months, or let's say. Really, for us, what transitory has meant is that if something is transitory, it will not leave a behind it permanently or very persistently higher inflation. So that's why we took a step back from transitory. We said expected to be transitory, first of all, to show uncertainty around that. We've always said that, by the way, in other contexts. We just hadn't done it in the statement. But also to acknowledge, really, that it means different things to different people. And then we added some language to really explain more what we're talking about in paragraph 2 and paragraph 3. We said that supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases. Then we said progress on vaccinations and an easing of supply constraints are expected to support continued gains in economic activity and employment, as well as a reduction in inflation. So we're trying to explain what we mean, and also acknowledging more uncertainty about transitory. So it's become a word that's attracted a lot of attention.
He's
that maybe
saying that
is
there's
distracting
uncertainty,
from
Tyler.
our message, which we want to be as clear as possible.
Even Powell's confused.
Ultimately, the only
the
other thing
message.
I would say is, look, we understand completely that it's particularly people who are living paycheck to paycheck or seeing higher grocery costs, higher gasoline costs. When the winter comes, higher heating costs for their homes. We understand completely what they're going through, and we will use our tools over time to make sure that doesn't become a permanent feature of life. Really, that's one of our principal jobs, along with achieving maximum
How
employment.
low-income families are living.
And that's our commitment.
Thank you. We'll go to Chris Rugaber of the Associated Press.
Great. Thank you, Michelle. Thank you, Chair Powell. Well, I wonder if you could update us. You talked about getting back to full employment. And so could you update how you define that? I mean, a few months ago, yourself and other Fed officials talked about getting back to the pre-COVID labor market. There was even hints you might try to do something better than that. Now we hear talk of, as you mentioned, people retiring, and there's talk of not being able to get back all the jobs back because of that and other trends. You did mention the prime age folks. So can you give us some examples of things you're looking at specifically to measure full employment? Will you be looking at prime age employment population ratio, for example? And if so, do you need to see that get back to pre-COVID levels to achieve maximum employment, or is there something short of that would work? Thank you.
So, thanks. So, maximum employment is it's a broad-based and inclusive goal that's not directly measurable and changes over time due to various factors. You can't specify a specific goal. So it's taking into account quite a broad range of things, and of course, employment levels of employment, participation. Are part of that. But in addition, there are other measures of what's going on in the labor market, like wages is a key measure of how tight the labor market is, the level of quits, the amount of job openings, the flows in and out of various states. So we look at so many different things, and you make an overall judgment. Now, the temptation at the beginning of the recovery was to look at the data in February of 2020 and say, well, that's the goal, because we didn't know that's what we knew, that was achievable in a context of low inflation. I think we're we're learning now. We have to be humble about what we know about this economy, which is still
guys.
very COVID affected, by the way. A lot of what we're seeing in the last 90 days is because of Delta. We were on a path to a very different place. Delta put us on a different path, and we see these things. But so I think we're going to have to. Ideally, we would see further development of the labor market in a context where there isn't another COVID spike. And then we would be able to see, I think, a lot. We would see how does participation react in that world, in that sort of post-COVID world. Right now, people are staying out of the labor market because of caretaking, because of fear of COVID to a significant extent. We thought that that schools reopening and elapsing unemployment benefits would produce some sort of additional labor supply. That doesn't seem to have been the case, interestingly. So I think there's room for a whole lot of humility here as we try to think about what maximum employment would be. We're going to have to see some time post-COVID so that we know, or post-Delta anyway, to see what is possible. And I think the learning for those of us who lived through the last cycle is that over time, you can get to places that didn't look possible. Now, What we also have now, though, is we have high inflation. So we have a completely different situation now where we have high inflation, and we have to balance that with what's going on in the employment market. So it's a complicated situation, and I would say we hope to achieve significantly greater clarity about where this economy is going and what the characteristics of the post-pandemic economy are over the first half of next year.
He's just hoping for the best right now.
Thanks. We'll go to Howard Schneider at Reuters.
Thanks, and thanks for doing this. So given that answer about employment, I would like to get back to Steve's question a little bit. On a headline basis, just as it's evolved this year, do you feel that the two tests on inflation have been met?
Sorry, the two tests?
The two tests in the statement, the guidance that it has to hit 2% and be on track to moderately be above it for 2%. Has the economy cleared that?
That's a decision for the committee. I would put it to you this way. When we reach maximum employment, when we reach a state where labor market conditions are at maximum employment in the committee's judgment, it's very possible that the inflation test will already be met. We're aware that language sounds a little out of touch with what's going on, but we're not at maximum employment. When that is the case, we'll look to see whether the inflation test is met. And there's a good chance that it will be if you look at how inflation has evolved in the last year and a half.
So to follow up here, so you're not willing to commit that the current levels of inflation and their persistence have met moderately and for some time. So given that, I mean, how should we render what moderately and moderately over and for some time mean?
What I'm really saying is that question is not before us right now. We had the question on when to taper. We've now answered that question and the speed of it and all that. We have not focused on whether we meet the liftoff test because we don't meet the liftoff test now because we're not at maximum employment. What I'm saying is, given where inflation is and where it's projected to be, let's say we do meet the maximum employment test. Then the question for the committee at that time will be, has the inflation test been met? And I don't want to get ahead of the committee on that, but the answer may very well be yes, it's been met. But we're not asking that question today because we're not running the liftoff test. We're not evaluating the liftoff test today. We didn't have that discussion at today's meeting. We did talk about the economy and the development of the economy, but we didn't ask ourselves whether the liftoff test is met because it's clearly not met on the maximum employment side.
Thank you.
Thank you. Let's go to Matthew Boesler at Bloomberg.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So when you're looking at this question of assessing whether or not the U.S. economy is at maximum employment, do you have a framework for making that judgment that is independent of what inflation is doing? And if not, does it kind of complicate that assessment given all of the uncertainty about inflation right now and the inclination?
You guys have enough of this? I think we got what we needed, right?
The high inflation
look
we're
at the
seeing
charts.
is not related to.
Let me know if we should look at the charts.
Capacity utilization in the labor market. Thank you.
So we don't actually define maximum employment as we define it in terms of inflation, but of course there is a connection there. Maximum employment has to be a level that is consistent with stable prices. But that's not really how we think about it. We think about maximum employment as looking at a broad range of things. You can't just look at, unlike inflation, where you can have a number. But with maximum employment, you could be in a situation hypothetically where.
All right, I think we got what we needed out of there. I mean, let's look at the market now. I mean, Nasdaq's up 120 right now, just ripping. Sorry, they're mowing the lawn outside my window, so if it gets a little crazy, let me know. Yeah, I mean, we're pushing highs here. Now that we got, I mean, essentially they're not raising rates and they're tapering a small amount. So, I mean, there's no reason why the market can't run. You know what I mean? Like, there's no reason why the market can't run. I mean, they're not. Now that we got the event out of the way, I mean, everything's running. I mean, Dow turned positive now. S&P's up 20. All-time highs. I don't think there's any concerns right now. I mean, the only concern was how much were they going to taper, and now that they're going to taper a small amount, they're only going to taper like 15 billion, right, out of the 120 billion. They're still going to be providing liquidity to the market. They're still going to be buying $105 billion worth every month. I mean, it's chilling now. Buy the dip, I guess. We just gotta buy the dip. I mean, and also, like, you know, we're headed up into the end of the year here, November, December. So unless something bad happens, I mean, the market's probably just gonna melt up. I mean, Tesla's ripping right now too. Yeah, Tesla's ripping right now. Probably gonna move back up to 12.25 up here. So, I mean, I think the news is, you know, for if you're bullish, good news. If you're bearish, I mean, then you're gonna have probably a hard time. I mean, you can't say the market can't gap down or, you know, can't go both directions. But right now, since when is it? Like, let's look at SPY here. I mean, since essentially, you know, basically beginning of October, we've gone straight up. And we've had some small dips, but we're just riding right now. It's a vibe. So I'm a sign off right now, guys. Just end of the day, you guys have a great day, and as always, stay safe, stay green. It's us versus herd.